Potential homebuyers have had a little luck in recent weeks. Mortgage interest rates continued to ease lower and dipped again last week under 6.2%, the lowest level for the 30-year fixed rate in over a year. Every little improvement in mortgage rates helps affordability, but affordability is a function of three variables, really. The cost of the house, the mortgage interest rate, and our income. Incomes have moved up in the last few years faster than home prices. Across the country, home prices are 1 to 2% higher than they were a year ago. Incomes are up by a nominal 4.6%. Very slowly, even as home prices have inched higher on average across the country, affordability has improved. Now, as mortgage rates dip, that helps homebuyers even more. There are two affordability-related questions on my mind as we wrap up the 2025 year and roll into the new year. First, are these little improvements enough to show up in the weekly home sales numbers? That is, will home sales finally climb out of the basement? And secondly, how do improvements in affordability compete with other fears and uncertainty building for the American consumer? One reason mortgage rates are easing lower is because unemployment is rising. We haven't had job uncertainty in this country in 15 years. Does that uncertainty keep potential homebuyers on the sidelines even as affordability improves? The data is not in yet, but that's what we're watching for. There are other risks for the housing market to contend with too. The immigration crackdown appears to be adding to housing market troubles in places like Austin. Austin not only has labor immigrants, but it also has a lot of H-1B visa immigrants, high-skilled immigrants. New regulations will make it harder for H-1B holders to get a mortgage. According to one estimate I saw from John Burns, the H-1B changes might remove another 0.5% to 1% of home sales. In places like Austin, where the housing market has already been hit pretty hard, this seems likely to exacerbate the challenges. In San Francisco and Silicon Valley, where there are a lot of H-1B holders, those housing markets have seen a bit of a boost from AI investments, so housing demand seems less likely to get hit as hard as Austin, Texas from the anti-immigration policies. That's a little speculation on my part, but worth following. The key here is that even as mortgage rates fall, there are new factors fighting against home buyer demand that we haven't had to deal with in many years. When those new fears are pitched against slightly improving affordability, we don't yet know which one wins the battle. So that's what we're watching for in 2026. In this week's data, we have a little bump up in inventory and transactions as the last stretch of the year before the holidays. In the weekly data, we want to stay tuned to whether sales volumes and prices stay above last year, or whether the new fears and bearish market forces start to bring those numbers lower than a year ago. So that's what we'll look at today. If you like these videos and our weekly housing market data, please add yourself to our Compass Intelligence mailing list. There's a link in the description below to join us. Click that link and add your name to the list. All right, let's look at the latest housing market data. I want to start today with that view that shows slight improvements in affordability that I mentioned and where we are compared to recent years. In this view, we have trends for a hypothetical typical mortgage. We take the current median price of the homes going into contract now. This is the price point where people are buying. And then factor in the current average rate that they'd get on a 30-year fixed mortgage. If we make some assumptions about down payment, then we can determine the monthly payment and see how that changes over time. As the mortgage rates are now at the lowest they've been in a year, the monthly payments are less than where they were last year at this time. So the median home price is $399,000 right now, and assume an 8% down payment with a 6.19% rate on the mortgage. That means right now a typical mortgage payment would be about $2,246. That is 1.5% cheaper than a year ago. The blue line here is 2025, and it's been easing lower with mortgage rates in the last few months. But most of the year payments have been higher than 2024. So the purple line from 24 shows the cheapest moment of the last few years was last September. Home buyers knew it and reacted at that time. That caused home prices and home sales to climb in response to that little surge in demand. So I like to say that consumers react more to changes in mortgage rates than to the absolute levels. And in this view, you can see that this year's payments have not changed that much yet. The change in payments in 2024 was much more abrupt, actually, and that led to more measurable changes in home buyer demand than we're yet seeing now. So 2024 went from a higher high to a lower low. My suspicion is that's why we're seeing slight growth in home sales now, but there's no big boost in the data. The available inventory of unsold homes on the market jumped a little this week to 868,000 single-family homes. That was a little more than I expected, but new listings and newly pending home sales also up this week. So I don't read too much into it. This week's jump seems like a little anomaly in the data due to the last week of the season, really. This coming week is the last week of October, and I expect to be fully into the autumn seasonal decline across the board by next week's video. There are 17% more homes on the market now than a year ago. So in this view, I have illustrated 10 years of inventory trends. Nationally, there are enough homes on the market to call it normal levels of inventory. The gray band is that at the top of the chart is that old normal range from last decade. That national average masks some important regional distinctions, of course. So some of the Midwest and Northeastern markets have still record low levels of inventory. So Chicago, for example, still has 75% fewer homes on the market than were normally available last decade. We have talked a lot about this two-tier housing market in the US. I keep looking for signs that we might finally see inventory growth in the northern states, and I just don't see any yet. The takeaway for inventory is that in the north isn't yet growing inventory. Across the Sun Belt, inventory is quite high, though the pace of that growth is slowing. There were 67,000 new listings this week. That was a little uptick for the week and is averaging just 1% more sellers each week than last year. In this chart, I have the new listings per week. Earlier in 2025, there were more sellers each week than in 24. Inventory was growing. That's the blue line here. Now there are basically the same number of sellers each week as last year. As I mentioned, places like Chicago or New Jersey still have very few new listings each week, and the pace of new sellers across the Sun Belt has dropped. This tells me that while inventory this year has averaged about 27% more homes on the market than a year ago, 2026 is probably going to be only about 10% continued growth. The pace of the new listings has slowed. So there are home buyers on the sidelines in many markets where prices are below last year. Deflationary temptation to wait longer is real. I recommend those folks watch the new listings levels to see if 2026 will add to that supply-demand imbalance or whether it rebalances a bit. It's looking now like rebalancing is coming. All right, let's switch to the weekly pending home sales data. We've been reporting for several months about how home sales, as measured by the weekly pending counts here, have been above levels of 2024. Home sales are a little better than last year. NAR reported last week their existing home sales data for September, and some folks were surprised that they measured sales gains over 2024. There are not a lot of sales gains, but the data is up. If you follow the weekly pending data, these gains are not a surprise. Now, as we end 2025 and transition into 2026, I'm watching for signs that sales growth continues to expand with slightly better affordability. There were 64,000 newly pending single-family home sales in the most recent week. That average has been hovering around that level for a month or so. Last year, it was about 62,000 per week. So each week sees about 3, maybe 5% more home sales happening now than a year ago. That's not a lot of home sales, but it is growth. Every little bit is encouraging. So the blue line in this chart is 2025, and it continues to report just a little above 2024's purple line. Condo sales have been averaging about 13,000 a week for a total of 77,000 newly pending home sales per week. That's not a huge number, but it is definite growth over 2024. So why are home sales growing but not growing quickly? Well, affordability is a little better. Supply is better. There's more selection for buyers. Also, Americans have delayed these moves for 3 full years. So every day more people feel compelled to move just based on life circumstances. I've also talked about how more people now have expensive mortgages to which they are not locked in. If you bought 3 years ago, it's much less painful to move than if you bought earlier and have a 2.5% mortgage. So all these factors lead to slightly increased home sales, and I anticipate that growth continues in 2026. So the data here are tracking the newly pending sales each week. These are not closed transactions, they are contracts started. The sale process typically takes 30 to 45 days to complete. So newly pending transactions today will close in November or December. And we know that many of these new contracts will fail. So there are lots of reasons that a contract doesn't close, things like financing or insurance. In many states right now, it's really hard to get fire or storm insurance, and that takes some potential buyers by surprise. As a result, the newly pending transactions are up by, say, 5%, but home sales might be up by 3%, still up. The takeaway here is that we continue to measure more contracts than a year ago. That points to slightly improved sales with slightly improved affordability. The median price of those newly pending sales is $399,000 now. That's unchanged for the week and is 2.3% higher than a year ago. Pricing by this measure has stayed more resilient than I expected. Watching the contract price is very useful, but it isn't the only way to measure home prices. In fact, the median price of all the homes on the active market is $438,000, which is 24 basis points below last year at this time. The median ask price now is nationally lower than last year. The median price of the newly listed cohort is $399,000, which is unchanged from last year. So these are the homes that are getting listed each week. And the median price per square foot is just under $214, and that's 57 basis points below last year. So of those 4 measures of home prices, and remember, these are all current signals for sales that'll happen in the future. These are leading indicators of future sales prices. So of the 4, 1 is up, 1 is flat, and 2 are fractionally negative compared to 2024. Meanwhile, the trailing indicators of home prices, like those that come from NAR or Case-Shiller, show about 2% home price increase versus last year. So overall, you get a picture that nationally, home prices are treading water for another year. Some measures are up a bit, and some are just below last year at this time. And in fact, that's probably a good thing. If home prices stay flat, but incomes increase and mortgage rates slide lower, that's a recipe for continued affordability improvements, and therefore slightly more sales to happen. So I'll call that an optimistic scenario. So that's all the data we have time for today. If you want to make sure you don't miss any of the weekly data and video commentary, you should sign up for our email list. There's a link in the description below for Compass Intelligence. Click that and add your name to the list. All right, everybody. Thanks so much. More next week.